Hello and welcome everyone to our live event. Today's topic is taxing times, end of year issues for 2025. Every accountant's favorite time of the year. Apart from, 15th of May is also year end, close to year end. Anyway, this event is brought to you by Tax Nuggets Academy. I'm Joyce, founder and CEO of Tax Nuggets, and I'll be your host for today. Let's introduce our instructor today. He's one of the most sought after tax trainers in Australia. In fact, he used to be my trainer as well. He is also a consultant for general and corporate tax. So please put your emoji hands together to give a very warm welcome to Meng Lee.
Good afternoon, Joyce.
Hi, Meng.
Hi, Dolly. Good afternoon, everybody. I trust everybody's ready for an hour of discussion about the year-end tax issues. Sorry,
you go, Meng.
Before we do get started, I just want to just make some preliminary comments. The session today, we've tried to identify some of the relevant year-end tax issues for SME practitioners. We're not able to cover everything because there is a large amount of material and issues out there that may be relevant to some of your client base, but we're not able to cover everything. So there will be some things that we're not looking at. For example, thin capitalization and the new fixed ratio test, the ATO's treatment of intangibles post PepsiCo, the new legislation dealing with BEPS Pillar 2 and the global uniform company tax rate. So there's a lot of material that we're not looking at today. What we've tried to do today is identify some of the relevant tax issues to the SME client base, and we're going to be focusing on that. So just a preliminary comment.
Absolutely. And also, this is more an intermediate to advanced level, Meng. Just looking at how many things we'll be covering today, the audience will be drinking from a fire hose, right?
Yeah, most certainly. In some of my sessions I do with Tax Nuggets, I do take some time to explain the background, etc. Today, it's going to be, identifying issues, and there's going to be a lot of assumed knowledge.
All right, let's get cracking then.
Before we do get started, if you do have any questions, queries, or comments, please feel free to post them. And we'll try and get to them at the end of the session today. We'll get to as many as we can at the end of the session today. Okay, so let's get started. What's our agenda for today? Well, we're going to be looking at some of the recent developments in the area of taxation that might be relevant to your client base. We're also going to be identifying some of the ATO areas of focus for 2025. So in January of this year, the ATO released a document outlining their areas of focus in terms of compliance activity for 2025. And we're just going to remind you of that and also highlight some of the key areas that might impact your client base. Now, we're not going to have time to cover each and every item in those areas of focus, but we will highlight some of the things that might impact upon your client base. We're then going to be looking at some of the tax issues from a year-end perspective that are relevant for individual taxpayers. In terms of looking at things like, marginal rates and thresholds, the traditional deferring income and bringing forward deductions, looking at some of the ins and outs with gifts and donations. What's relevant for individual taxpayers, of course, are the changes to HECS or HELP that are being foreshadowed by the government. Also, a big issue for individual taxpayers at year end will of course, be managing their superannuation contributions as well. From a company perspective, we're going to be looking at determining whether or not you're an SBE or a base rate entity. And this is a relevant issue year ending 30 June. Working out whether or not a company that you're dealing with is a small business entity or a base rate entity, and the consequences that flow from that. We're also going to be focusing today on Division 7A, and of course the treatment of unpaid entitlements post Bendel's case. No doubt everyone's aware of the full federal court decision being handed down on Bendel versus the Federal Commission of Taxation, and the implications of that going forward for practitioners from a practical point of view. The other thing, of course, is you no doubt would be aware as well that the ATO recently did a roadshow on Division 7A. And because they were concerned that a lot of practitioners still didn't understand, how Division 7A operated in the context of companies and shareholders. And as part of that roadshow, the ATO has warned that a focus of their compliance activity here ending 30 June 2025 is going to be making sure that taxpayers comply with their Division 7A obligations. Last but not least, we're going to be looking at trusts and some of the things that you need to be aware of at 30 June when you're dealing with trusts, and also the ATO's new guidelines on Section 99B as well, which is probably the most significant development in this area for 2025. Okay, so fairly full agenda. We're going to try and get through as much as possible. And like I said, if you do have any questions, queries, or comments, please feel free to post them. So let's get started. In terms of the latest developments, no doubt you would have been aware that the federal budget was handed down in March of this year, and this was very much an election budget. As a result, the government has chosen not to rock the boat, preserve the status quo. So from a tax point of view, there were not any significant developments, aside from the announcement that the government is going to be cutting the 16% marginal rate to 15%, effective from the 1st of July 2026. And that rate will then be further cut to 14% from 1 July 2027. For those of you not aware, the legislation implementing this rate cut has actually been passed by Parliament and in fact received royal assent as well. So those changes are now part of the law. The other thing that was announced by the government, which will put a smile on the face of anyone with a HECS or HELP debt, is the proposal by the government to provide anyone with a student debt with a 20% reduction in their outstanding higher education loans. So anyone with a HECS or HELP debt, the government will be providing you with a 20% reduction or a 20% discount. So whatever your balance is, take 20% off, and that will be effective from the 1st of June 2025. So prior to the government applying the indexation factor from 1 June 2025, the 20% reduction will apply. So that's significant as well. The government also did announce that they're going to be deferring the start date of the foreign resident CGT changes from 1 July 2025 to the first 1 Jan, 1 April, 1 July, 1 October, after the date of royal assent of the amending legislation, whenever that will be. For those of you not aware, the government proposed to make some changes to the capital gains rules in the previous budget. And they've introduced legislation to that effect, but they've deferred the start date now till the date of royal assent of the amending legislation. Okay. For those of you who were concerned about the status of the instant asset write-off, keeping in mind that up until recently, the $20,000 instant asset write-off for small business taxpayers had not been legislated for year ending 30 June 2025. Well, that legislation has now been passed by Parliament, implementing the instant asset write-off for small business entities for year ending 30 June 2025 and maintaining that write-off threshold at $20,000. The government have also basically put out an announcement that if they get re-elected, they will now extend that $20,000 instant asset write-off for a further 12 months till 30 June 2026. If they do not get re-elected from 1 July 2025, the instant asset write-off threshold drops back to $1,000, and that's something that you should be aware of.
Oh, so the coalition didn't respond to that?
No, the coalition have not responded to that. No doubt, they may come up with something if they are elected, but we'll just have to wait and see. The government have indicated that if they are re-elected, they will extend the $20,000 write-off for a further 12 months. But we'll just have to wait and see what happens on Saturday.
That's right.
The other thing to note there, of course, is that the legislation implementing the removal of the deductibility of GIC and SIC, the legislation implementing that has actually been passed by Parliament. For those of you wondering what the Act was, it's Treasury Laws Amendment, Tax Incentives and Integrity Act 2025. That legislation received assent on the 28th of March, and that particular piece of legislation implements the removal of the deductibility of SIC and GIC, effective from 1 July 2025. Keep in mind, with this particular measure, it doesn't matter when you incurred the debt. The non-deductibility will apply to any interest that's accrued on or after the 1st of July 2025. Okay? So from a year-end perspective, one of the things that we'd be wanting to talk to our clients about is making sure that they lodge and pay on time, because going forward, any GIC that they accrue will be non-deductible.
Yeah, it also might want to tidy up those existing debts, because any new GIC and SIC will be non-deductible.
Very, very good point there. Very, very good point there. That if you do have any outstanding tax debts, any GIC that accrues after 1 July 25 will be non-deductible. Keeping in mind as well that the GIC rates are prohibitive. So one of the things that a lot of clients are looking at is basically trying to get external financing to pay off their tax debts if they do have any unpaid tax debts, because rather than having to have deal with GIC, which is quite prohibitive.
Oh, will that be deductible, the external debt?
That's an interesting question. I would argue no, because
it's you're paying for you're borrowing to pay off something that's non-deductible.
Correct. And it's a long bow to draw to say that it's an expense incurred towards earning income, or an expense incurred in respect of a business, arguably. So I think in a lot of circumstances there, that interest that you would incur on third-party debt that you use to pay off a tax debt so that you don't have to pay GIC, I'd argue would be non-deductible.
I'm sure the ATO will release some guidance on that, because that would be a very common question very soon.
Yes. What else in terms of latest developments? For those of you looking at claiming deductions for work from home expenses, there's a new guideline been released by the ATO increasing fixed rate from 67 cents to 70 cents per hour, basically for the year ending 30 June 2025. So a lot of us now work from home, because and it's something that you need to consider. The coalition and the government have also announced, various proposals as well in the event that they do get elected. I'm not going to bore you with the details there. They're on the slide. One of the things that I did just want to highlight very, very quickly, of course, was the government proposal to introduce $1,000 standard deduction. So the government have indicated that if they are elected going forward, taxpayers will have a choice of claiming a deduction for work-related expenses and having to substantiate that expenditure, or just claiming $1,000 standard deduction. So this proposal came up a little while ago, but it's now been revisited by the government. We'll just have to wait and see. Okay. So that's like the latest developments, which are relevant from a year-end perspective. Moving right along. The next thing I wanted to just have a quick brief look at was the ATO Areas of Focus. So this is basically a document that was released by the ATO outlining where they're going to be focusing their compliance activity for the 2025 financial year. The ATO, like any other large organization, has limited resources has limited resources which they can access. And as a result, they've got to focus their resources on particular areas. And for year ending 31 January 2025, the ATO have basically said, look, these are the areas that we're going to be focusing on in terms of our compliance activity. These are the areas that we're going to be focusing our resources on. And they're highlighted there on the slide, and I don't have time to go through each and every one of them. We've already identified Division 7A as one area. The other area, which the ATO are very strict on focusing on, will be registration, lodgement, and payments. So one of the things that the ATO has identified is that there's a lot of taxpayers that don't lodge and pay on time, and there's a lot of taxpayers basically that, do not comply with their lodgement and payment obligations. And one of the areas of focus of the ATO is to make sure that taxpayers are complying with their lodgement and payment obligations. The removal of the deductibility of GIC and SIC will certainly incentivize taxpayers to do that. No doubt most practitioners would also be aware that the ATO now are much stricter in terms of remissions of general interest charge, in terms of when you put in a request for remission of a general interest charge, the ATO are much stricter in allowing those remissions. So this is all part of this program to make sure that taxpayers are lodging and paying on time. What else is the ATO going to be focusing on? The property and construction area is always an area where the ATO focuses their compliance activity to make sure that taxpayers are complying not only with their income tax or GST obligations. One of the areas where they're looking at as well is distributions from foreign trusts. So the ATO's issued guidelines on Section 99B. And so one of the areas they're going to be focusing on is resident taxpayers receiving distributions from foreign trusts, making sure that they're complying with the requirements outlined under Section 99B. If we go over to the next slide, another area that they're going to be looking or focusing on is GST, and in particular, basically incorrect claiming of GST refunds without sufficient evidence to substantiate claims. The ATO has seen a large proliferation of taxpayers basically making claims for GST credit where they have got inadequate substantiation, and claiming refunds, in those circumstances as well. So that's another area of focus. What else? Very, very quickly. They're also going to be looking at things like share buyback arrangements, thin capitalization, cryptocurrency, and of course, self-managed super funds. That's always the focus of the ATO, making sure that, taxpayers with self-managed super funds are not only complying with their income tax obligations, but the obligations under the SIS Act as well.
Interestingly, what is not on the list is Section 100A.
Well, I think, that's the ATO, that's assumed that, that's going to be an area of focus,
Oh, it's just assumed. Okay.
But, because you may or may not be aware, but there's the ATO set up a trust task force now. And so that, their responsibility is to focus on areas like Section 100A, et cetera. Mm-hmm. So, and trusts are always an area of focus.
Okay.
But this, I guess, is like a document that says, hey, in addition to what we ordinarily look at, these are things that we're also going to be focusing our efforts on as well.
Right. Fair enough.
Okay. So very, very quickly, from the perspective of individual taxpayers, what are some of the year-end tax issues that are relevant for individual taxpayers? Well, as is always the case, ending 30 June 25, we always publish what the marginal rates are. And if there are any changes in the marginal tax rates for individuals, we do always, publish that and sort of say, if there are, reductions in the marginal rates from a year to year, there's an incentive to, defer the recognition of income to the following year because you're going to pay less tax, that's natural. But in this particular year ending 30 June 25, there are no changes to the marginal rates and thresholds for the 25-26 year. We have indicated that there's going to be a reduction in the 16% rate, but that's effective from the 1st of July 2026. In terms of some of the traditional strategies for year-end tax planning for individuals, that's highlighted on the next slide. And then the traditional strategies of deferring income and bringing forward deductions. Look, like I said, I'm not going to spend too much time on this. But, if you are looking at deferring income, one of the things you got to look at, of course, is making sure that if you are a cash basis taxpayer or an accruals basis taxpayer, because as an accruals basis taxpayer, deferring the actual receipt of the income may not necessarily help you. Why? Because generally speaking, accruals basis taxpayers are taxed on an invoice basis. Okay, so whereas if you're a cash basis taxpayer, deferring the receipt of that income will also, of course, defer the recognition of that income for income tax purposes. A very good example of that, of course, would be if you're an individual taxpayer and you're entitled to receive a bonus payment. You might want to defer the receipt of that bonus payment until after 1 July to defer the recognition of that income. Okay, in terms of property transactions, as we all know, CGT is triggered on a disposal of a CGT asset on contract. So when you actually enter in the contract or when you settle on the contract is not as relevant as when you enter into the contract. So if you want to defer the recognition of a capital gain, you might want to actually defer executing the contract until after 1 July. From the point of view of bringing forward deductions, one of the best ways of doing that, of course, is prepaying expenditure for a subsequent year in the current year. But if we do that, we've got to remember the application of the prepayment rules. Generally speaking, the prepayment rules basically say, well, if you prepay expenditure in the current year, you can't claim a deduction for that prepayment in the current year. You've got to amortize that prepayment over the service period. But there are concessions available to SBEs and individuals deriving non-business income. The general rule basically is that if the prepayment relates to the next 12 months and the next 12 months only, then you can prepay the expenditure in the current year and claim a deduction in the current year, even though it relates to the subsequent year. Okay. If you are an SBE and a sole trader, you've got the simplified depreciation rules and access to the instant asset write-off as well. And also keep in mind, if you are a sole trader and an SBE, one of the concessions available to small business entities is that if you've started up a new business in the current year, you can write off your business formation costs in that year rather than having to amortize it over 5 years at 20% per year under Section 4880. Okay.
Very good reminders.
Yeah. So there's some things for individual taxpayers. Some of us, who are altruistic may want to make gifts or donations to charities. Keep in mind, you can only claim a tax deduction if the gift or donation is made to a deductible gift recipient. So you've got to establish the status of the charity or benevolent organization that you're donating to. Also, remember, you can only claim a tax deduction if you're not getting a material benefit in return. Okay, so that's something to be aware of as well. So keep in mind there. The HECS or health changes, like I said, are a big ticket item for a lot of taxpayers with student loans. And one of those, of course, is the 20% reduction for student loans. One of the things that some practitioners have identified as a planning idea is that your HECS repayments are based on, your HECS repayment income, which is determined by what you've disclosed in your tax return for the prior year. So the 23-24 year, in this case here, it would be the 23-24 year. Mm-hmm. Some basically accountants have indicated that one of the things that, that taxpayers might want to think of to take advantage of this 20% reduction is actually to defer your lodgement of your tax return until after during 2025, so that the government can apply the 20% discount if and when it happens. Okay, so that's something to consider from a planning point of view as well.
But is the HECS thing legislated?
No, it's not. So it's still a proposal. That's depending on what happens on Saturday as well.
Yeah, sounds good.
In terms of superannuation, if you're an individual taxpayer, one of the things that you might want to be looking at is making personal deductible contributions or concessional contributions prior to 30 June and claiming a tax deduction for that if you are eligible. Keep in mind the concessional contributions cap for year ending 30 June 2025 is $30,000. Couple of things that you need to be aware of if you do want to claim a deduction for a personal contribution. Number one thing basically is that the contribution must be made to a complying fund before 30 June. Okay. I've seen a number of times where clients purportedly make contributions prior to 30 June wanting to claim a tax deduction, but the reality is that they're not entitled. Why? Because the money doesn't hit the super fund until after 1 July. Okay. You also need to make sure that you satisfy all the CIS requirements in terms of, being of the correct age, etc. Number one thing, if you want to claim a deduction for a personal super contribution, you've got to provide valid notice to the trustee of the fund. Okay. So you've got to notify the trustee of the fund that you're intending to deduct the personal contribution, and you've got to also receive acknowledgement of that notice as well in order for the contribution to be deductible. That's one of these quirks that are often neglected by a lot of taxpayers and practitioners.
Even for both self-managed as well as APRA funds?
Well, I think with a self-managed super fund, you're the trustee, you're the member. From a practical point of view there, you can say, hey, look, I've provided myself with notice, but you still got to fill all the documentation in. Mm-hmm. And then you can acknowledge that notice fairly easily. But if you're a member of an APRA fund, it's very important. Mm-hmm. You provide the notice and get acknowledgement of the notice before you can actually deduct the contribution for the relevant year.
Wow.
Okay. Keep in mind the bring forward concession. So if you haven't used up your concessional contributions caps in a prior year, you may have the opportunity in the current year to increase your concessional contributions threshold by taking advantage of the concessional contributions caps from the prior years as well. The non-concessional contributions cap for year ending 30 June 25 is $120,000 or $360,000 over 3 years. But remember with the bring forward rule, remember with non-concessional caps, how much you can actually contribute as a non-concessional contribution is dependent on your total super balance. Okay, if your total super balance exceeds $1.9 million, you are not entitled to make a non-concessional contribution. And the total super balance cap currently is 1.9 million. It's the same as a transfer balance cap. Okay. Downsizer contributions are also something that your clients might consider year ending 30 June 25 as well. Keep in mind, if you do want to make a downsizer contribution, there are requirements you have to satisfy. One of those is that you've got to be 55 or older. The other is that you've got to have owned the property for at least 10 years. The property has to have been your main residence at some time during your ownership period. Provided that's the case, you can dispose of it and put up to $300,000 of the proceeds into super as a downsizer. The value of a downsizer contribution from a year-end perspective is it doesn't count towards your concessional or non-concessional caps. Okay. What else? CGT, is there an opportunity year ending 30 June, particularly in this falling market, to realize some capital losses to offset some capital gains that you've derived during the year? Thank you, Mr. Trump, for basically destroying the stock market. So, hey, we're in a falling market at the moment. For those of you with share portfolios, no doubt you'll be seeing that there's some fairly significant losses. Is there an opportunity to realize some losses to offset against capital gains that you might have derived during the year? Be careful, however, about the ATO's ruling on wash sales. And what I'm referring to is a situation where you might sell a stock prior to 30 June, realize the loss and to offset against the gain, and after 1 July, buy back the very same stock again. So be careful about doing that. But there's nothing stopping you, for example, realizing a loss, offsetting that against a capital gain, and then diverting the funds into some other investment. You know what I mean? So that's something to be aware of as well. Last but not least, in terms of ATO compliance activity from an individual taxpayer's perspective, the ATO is always focusing on work-related expense claims. In particular, making sure that, number one, the expenditure is in fact, incurred in deriving, whatever employment income or income derived by the taxpayer. Number two, making sure that taxpayers are complying with all the substantiation requirements. Classic example would be taxpayers who are claiming a deduction for car expenses. If you're claiming a deduction for car expenses, there's only two methods to calculate your deductions for car expenses. It's the cents per kilometer method or the logbook method. One of the most important things, if you are using the logbook method, or is that you actually have a valid logbook. And I can't tell you from experience with clients, the number of clients that do not have valid logbooks, do not comply with the ATO's requirements as to what a valid logbook is. Okay. Mm-hmm. And it is one thing that as practitioners, we need to make sure that clients are aware of year ending 30 June is that they want to deduct the expenditure, they've got to satisfy the substantiation requirements. If you want to deduct an amount for car expenses, you've got to have a valid logbook. And you need to make sure that you inform your clients what the requirements are for a valid logbook.
For those online with us today, any suggestions for good logbook apps? You might want to just drop it in the chat so we can all share. Send it to your clients, because handwritten things are just not good anymore.
Oh, look, I think gone are the days now. I think where people actually, still have that, book that you buy from the newsagents and get the pens and you fill it in, after the trip, and put it in their glove box. I think those days are gone now. Now everyone's got a smartphone, they sync it to various apps or whatever. Only problem with that is you can't fudge your logbook. Only kidding.
That's a good problem.
What else? Very, very quickly. We're all tax agents here. We're all registered tax agents and tax practitioners. We're no doubt aware that the Tax Practitioners Board has been given increased legislative power to oversee tax agents. One area where the Tax Practitioners Board is focusing heavily on is making sure that individual tax agents are complying with their own personal tax affairs. And so one thing, and it's a motherhood statement, no doubt about it, but I want to warn everybody here that, they need to make sure that their own personal tax affairs are in order, because that's an area of focus of the Tax Practitioners Board in terms of their, compliance or enforcement activity. Okay. that's the discussion from an individual's perspective. We're going to very, very quickly look at some issues that are relevant for corporate taxpayers. And one of the areas that we're going to be looking at is the difference between a base rate entity and what's called a small business entity. Now, it's important to know what a base rate entity is because for year ending 30 June 25, we want to be able to know whether or not the company that we're dealing with has a corporate tax rate of 25% or 30%. Now, the criteria for determining whether or not a company is a base rate entity, the law basically says in order to be a base rate entity, a company has to have aggregated turnover in the current year of under $50 million. And aggregated turnover, remember, includes not only the turnover of the company in question, but connected entities and affiliates as well. And in addition to that, the company also has to satisfy what's called the 80% base rate entity passive income test in the current year. One of the things that's often neglected and often a lot of practitioners don't realize is that the rate at which a company can cite a dividend in the current year is not based on the company's tax rate in the current year. It's actually based on the aggregated turnover of the company in the prior year and whether or not the company satisfies the 80% base rate entity passive income test in the prior year as well. So your corporate tax rate is based on your turnover and your income in the current year. But your franking rate, the rate at which you can frank dividends, is actually based on your prior year figures. And that's often neglected. Now, in most circumstances, your corporate tax rate is going to be your franking rate as well. But that's not necessarily always the case. And that is one of the things at year ending 30 June 25 that's often neglected by a lot of practitioners. And just very, very quickly, the other thing that I wanted to highlight is that there's an incorrect assumption by a lot of practitioners that if you're an SBE, you're also a base rate entity automatically as well. And that's not necessarily the case because the criteria for determining whether or not you're an SBE are wholly different to the criteria for determining whether or not you are a BRE. In order to be treated as a small business entity, you've got to be carrying on business in the current year, and your aggregated turnover in the prior year, because you always look at prior year first before you look at the current year, has to be under 2 million, 10 million, or 50 million, depending on which concession you want to access. So there will be situations where a client will be an SBE in the current year, but there will not be a base rate entity because the criteria are wholly different. Because in order to be an SBE, you've got to have turnover under the threshold and be carrying on a business. In order to be a base rate entity, you've got to have turnover under the threshold in the current year and satisfy the 80% passive income test. There are small business entities that don't satisfy the 80% passive income test, but are nevertheless small business entities. So that's something I want to highlight. Why? Because there's a common misconception, and it's relevant for year end because it's important to know whether or not you're an SBE or BRE at 30 June because it determines your company tax rate. It determines whether or not you can access concessions like simplified depreciations. But the criteria are wholly different, and that's why it's a relevant year end issue.
Yep.
In terms of
reminder.
In terms of a quick reminder of what I'm talking about, just very, very quickly. I'll just go back to the next slide. This is an illustration of what I'm talking about in terms of the differences between the franking rate and the corporate tax rate. So year ending 30 June 24, we got a company with aggregated turnover of 51 million. And because they've got turnover more than 50 mil in the current year, the corporate tax rate for the 24 year is 30%. In the subsequent year ending 30 June 25, our aggregated turnover has now fallen to $49 million. So because they've got turnover under 50 mil and we've assumed they satisfied the passive income test, you've got a company tax rate of 25%. But if you would pay a frank dividend year ending 30 June 25, you would be franking that dividend at 30% because your franking rate is based on your aggregated turnover in the prior year. Fast forward to year ending 30 June 26, your aggregated turnover is now 52 million. So you're back up to 30% in a corporate tax rate, but you only get the frank dividends you pay 30 June 26 and 25% because once again, it's based on the prior year. Okay, so just to highlight a common area where you've got some errors. Very, very quickly, I just wanted to briefly talk about the instant asset write-off. In particular, the fact that in order to get access to the instant asset write-off, you've got to be an SBE, turnover under 10 million, carrying on a business. But you've also got to elect into simplified depreciation. In other words, you're not calculating depreciation on your plant equipment using Division 40. You're calculating depreciation using Subdivision 328D. Getting access to the instant asset write-off requires you to elect into simplified depreciation. If you don't elect into simplified depreciation, you cannot get access to the instant asset write-off. Common misconception that it's available to all SBEs regardless. No, it's not. You've got to elect into simplified depreciation, and the asset has to be used or installed ready for use prior to 30 June. Really relevant for someone who, for example, wants to purchase a motor vehicle that's under $20,000 and write it off. Okay, they go to the dealership on the 25th of June, sign the contract, purchase the motor vehicle. They don't take delivery until after 1 July. Sorry, can't claim the write-off the ending 30 June because the asset wasn't installed ready for use prior to 30 June. Okay, we've talked about the machinations with the instant asset write-off threshold already, so I won't bore you with the details there. Look, there's a bit of a discussion there about super guarantee and the increase in the SG rate from 11.5 to 12%. And a quick reminder that the SG rate for the quarter ending 30 June 25 will continue to apply to be 11.5%, even though the due date for paying SG is 28 July. So basically, if salary and wages were paid before 30 June, even though the SG is paid at 28 July, the SG rate will still be 11.5%. But super guarantee is applied to ordinary time earnings. So if the employee receives the money after 1 July, even if some of those, even though that payment was paid, after 1 July, even though that payment relates to earnings prior to 30 June, the SG rate on those earnings will still be 12% rather than 11.5%. So it's when the earnings are paid determines what the super guarantee rate is in terms of the application of the increased super guarantee. Moving right along, Division A.
Can we just touch on Payday Super? When's that kicking in?
Oh, sorry.
Yeah, not anytime soon, yeah?
No.
1 July 26.
2026. So draft legislation has been issued by the government outlining the operation of the Payday Super rules. That's going to be applicable from the 1st of July 2026. For those of you that don't know what I'm talking about, that's the proposal by the government to basically say rather than paying super quarterly, employers will be required to pay super basically 7 days after they pay salary and wages. So if you pay your employees monthly, 7 days after you pay your employees, you got to make sure that you put the necessary super contributions into their super fund. If you pay your employees weekly, then you got to make sure that you comply with their 7 days requirements. Based on when you pay your employees.
Yeah, and Coalition is on board with this. Yeah, it's definitely staying.
Well, they're a bit silent on this. I mean, the last time I looked, they hadn't indicated that they were going to support or not support. I know for a fact that this area is, I think, going to be a real concern for small business.
Oh yes, huge.
Big in the town, you've got electronic payroll. Press a button, pay super at the same time as you pay salary and wages. That's fine. If you've got someone who's a small employer, particularly in the hospitality industry, where you've got a lot of casual employees, people that work sometimes, they don't work other times. They're not necessarily full-time employees. Books, they're casual, etc. It's gonna, or you might hire them for a one-off event or whatever. It's going to be really difficult for some of these employers, to comply with these rules.
Yeah, no doubt we will have more events around Payday Super because it's going to be huge.
Oh, look, in terms of compliance, it's going to be an absolute nightmare. Because you think about it, you bring an employee on, you got when you onboard them, you got super choice, you got all of that, you got all those forms that they need to fill in. And if it just so happens that they come on board just before a pay run, it's going to be a real difficult for employers to comply with those requirements.
And I think the clearinghouse is going to go as well, the small business clearinghouse.
Yes, it's clearinghouse has been effectively, I guess,
disbanded.
Disbanded or wound down. And employers will not have to rely on commercial clearinghouses.
Yep. Anyway, watch this space.
Exactly right. Very quickly, as I mentioned previously, Division 7A is an area of focus of the ATO for year ending 30 June 25. For those of us who've got clients with debit loans to shareholders, reminder that the benchmark interest rate for 30 June 25 is 8.77%. Okay. Now, what's the implication of that? Well, the implication of that, of course, is that if you are making minimum loan repayments on Div 7A loans for year ending 30 June 25, the interest rate is 8.77%, which is quite high. The other thing to note with all of that is it doesn't matter when you entered into the loan. If you are making a loan repayment year ending 30 June 25, you've got to apply the 30 June 25 benchmark interest rate, okay, when calculating the interest on that loan repayment. For those of us with, new debit loans for year ending 30 June 25, remember that you need to put those loans under a complying loan agreement by the lodgement date of the 25 return, which will not until be May 2026. You've also got to make sure that if you've got existing Division 7A loans, you've complied with your minimum loan repayment obligations by 30 June. If you are declaring dividends and you are offsetting the dividends against your loan repayment obligations, remember the dividends have to be declared and the offset has to occur prior to 30 June. Now, when we do the actual loan entries, it really doesn't matter, okay? But there needs to be evidence that the dividend was declared and the offset occurred prior to 30 June to comply with your loan repayment obligations. Keep in mind as well that we're not just looking at loans from companies to shareholders. You've also got to be aware of interposed entity arrangements as well. So loans from interposed entities to related parties or shareholders, where it's clear that the funds have come from a third-party entity and has been rerouted through an interposed entity, there are Division 7A implications there. That's an area of focus of the ATO because they've issued some rulings and guidelines in that area. The other area of focus will be Subdivision EA. Subdivision EA is the provision that basically says, hey, if you've got an unpaid entitlement from a trust to a company, forget about Bendel, forget about how the ATO treats that arrangement. The loan from the trust to a related party of a shareholder in the company or a beneficiary who is a related party of a shareholder, that loan from the trust can be treated as a Division 7A loan. So on top of Bendel, Subdivision EA is another provision that says, hey, if you've got an unpaid entitlement from a trust or a corporate beneficiary, forget about Bendel and whether or not that UB should be treated as a Division 7A loan or not. If there's a loan coming from the trust to a beneficiary of the trust who happens also to be a shareholder or related party of a shareholder of the company, guess what? That loan can be treated as a Division 7A loan. And I'm going to talk a little bit more about that when we look at Bendel in detail. If you look on the next slide, you'll see there's a timeline basically outlining all the key dates that you have to be aware of. So for year ending 30 June 24, if you've got a debit loan, the loan agreement for the debit loan has to be in place by the lodgement date of the 24 return, which we've assumed is the 15th of May 2025. The first loan repayment that you have to make on that loan amount is the 30th of June 2025. Interest is calculated from the 1st of July 24 to 30 June 25. So it doesn't matter when you drew down the funds. It doesn't matter that you might have drawn down the funds on the 1st of January 2024. Interest is still only calculated from the 1st of July 24 to 30 June 25 on that loan repayment. Key point here is the loan agreement has to be in place by the lodgement date of the 23-24 return, which is the 15th of May, which is next week. The first loan repayment is the 30th of June 2025. Okay. So something to be aware of there.
And loan agreements need to be before the due date, yeah? So the latest date has to be 14th of May, yeah?
Well, at or before the lodgement date of the company.
At or before? Okay.
Now, key point here is if you get an extension of time to lodge, you still have to have the loan agreement in place by the 15th of May 2025.
Okay.
Okay. So, in terms of timelines, let's talk about Bendel, UPE's post-Bendel. There's no doubt that everyone's been aware of the fact that there's been, a lot of discussion about, the treatment of unpaid entitlements from trust to corporate beneficiaries post the full federal court decision in Bendel. Now, I'm going to assume everyone knows the facts of Bendel. I'm going to assume that everyone is aware of the implications of Bendel's case. Now, for just quick brief summary, Bendel's case dealt with the issue of whether or not an unpaid entitlement from a trust to a corporate beneficiary was in fact a loan from the company to the trust for Division 7A purposes. As you are all aware, the ATO view for the last decade or and a half or so has been that where you've got an unpaid entitlement from a trust or a corporate beneficiary, it is the company providing the trust with what is called a financial accommodation. Tax determination 202211 basically says, if the trust is aware of the amount of its present entitlement, if the company is aware of the amount of its present entitlement, okay, if the company chooses not to call on those funds, the company is taken to provide a financial accommodation to the trust, and therefore that is deemed to be a loan from the company to the trust for Division 7A purposes. If the trust happens to be a related party of a shareholder, we got a Division 7A loan. Okay? There's always been some contention with practitioners and the ATO as to whether or not this is a correct view. And so this was tested in Bendel's case. And as you're probably all aware, the full federal court resoundingly came down in favor of the taxpayer. Basically, what the full federal court said in Bendel's case was that an unpaid entitlement from a trust to a corporate beneficiary is not a loan in accordance to Section 109D of Division 7A. Why? Because there's no obligation to repay. Okay? With an unpaid entitlement. Okay? Yes, the trust owes the company money. But if the company never calls for the funds, the trust is not under an obligation to pay that money across to the company. Whereas with a loan, there's an obligation to repay. And therefore, that's one of the key characteristics of a loan as such. So basically what the full federal court said was it's apples and oranges. A UPE is not a loan, so therefore Section 109D cannot apply to unpaid entitlements from trust to corporate beneficiaries. Okay? What's the practical implication of this? Now, for us tax nerds, we all get excited about this, but what's the real practical implication? Number one, first things first, just to update you. The ATO has indicated they're going to appeal this case to the High Court. Whether or not the High Court's going to hear the appeal, we're just going to have to wait and see. Keep in mind that in Bendel's case, it was a unanimous decision. All three judges in the full federal court found in favor of the taxpayer, which is very unusual. So I'm not sure. There was no dissenting judgment here. So I'm not sure what the ATO is going to base their appeal on. But nonetheless, the other thing that the ATO has done is issued an interim decision impact statement, basically saying, we don't care what the full federal court says. We're going to continue to administer the law in accordance with TD 202211 until we hear what the outcome of the High Court is. Okay? By the way, the ATO says, where you've got an unpaid entitlement from a trust or corporate beneficiary, well, if Division 7A doesn't apply, we can still look to apply Part 4A, which is the General Anti-Avoidance Provision, or Section 108. Because we consider that, hey, where you've got a company or trust making a company presently entitled, and guess what? The trust not paying the funds across to the company and the company allowing the trust to basically retain the cash in the trust, hey, guess what? That's a reimbursement agreement, and potentially Section 100A could apply. Okay? So the ATO is basically saying, hey, there's different ways to skin a cat. But at the moment, the ATO view basically is, despite what the full federal court says, we're going to continue to administer the law in accordance with TD 202211. And their view in TD 202211 is that the company is providing the trust with a financial accommodation that is deemed to be a loan from the company to trust for Division 7A purposes.
Yeah. So what's your advice being for FY23 UPEs that are, need to be managed, by 15th of May this year? If people haven't entered into or made it into a complying loan or haven't managed it yet, what's your, key recommendation there?
I guess this is the key point with all of this discussion, okay? And this is my opinion only. It's my opinion only, and I have to preface that. It's not, like I said, something that, it's my opinion only. Clients that have asked me and discussed this issue with me, what I've said to them basically is, as far as I'm concerned, for year ending 30 June 25, or for year ending 30 June 23, I should say, it's business as usual. Okay. Keeping in mind the ATO's comments in its interim decision impact statement, keeping in mind that the case has been appealed to the High Court, as far as I'm concerned, it's business as usual in respect of unpaid entitlements from trust or corporate beneficiaries for year ending 30 June 23. And there's two reasons for that. One reason is that Bendel is only really relevant from a Division 7A perspective if you have an unpaid entitlement from a trust or corporate beneficiary, but the money never leaves the trust. In other words, the money is reinvested in the business of the trust or reinvested in the activities of the trust. What you'll find practically in a lot of circumstances, that's not the case. Where you got a UPE from a trust or a corporate beneficiary, the funds never just sit in the trust. The funds somehow appear in the hands of a related third party. Now, if that is the case, Bendel's not the issue. Subdivision EA is the issue. Because we've got a UPE from a trust or a company and then a loan or a payment from that trust to a related party. Okay? So that's why I say to a lot of clients, look, it's business as usual. Why? Because a lot of times they don't track what happens to the money that sits in the trust. So, hey, why not we just make sure that we deal with the arrangement that we got in front of us and say, hey, okay, you got a UPE from a trust or corporate beneficiary. We put it under Division 7A complying loan agreement. We make sure we pay it back over 7 years, benchmark interest and principal, etc. The reason why is because the ATO has indicated in its practical compliance guideline, if we do that, 100A1 apply, because that's treated as an ordinary family commercial dealing. Number two, if we put that under complying loan agreement, then we don't need to worry about what happens to the money once it leaves the trust.
Yeah. The way I say is the money's been squirted out somewhere else already. So subdivision EA is the risk there.
That's my personal opinion only as to what practitioners want to do going forward. That's entirely, their own perspective. The other thing to note, and this is a practical thing to be aware of, is that for a lot of the prior year arrangements, okay, the decision in Bendel will not impact those prior year arrangements. And the reason why I say that is because for a lot of prior year UPEs, those have already effectively been converted into Division 7A loans. Because most complying taxpayers would have followed the Commissioner's guidelines and said, hey, I've got a UPE, I don't want Division 7A to apply to it, so what I'll do is I'll put it under a complying Division 7A loan agreement, pay it back over 7 years, interest and principal. Now, the moment that you did that, you converted the loan from a UPE to a loan. So it's no longer the issue of whether or not the UPE is a deemed loan. You've actually converted it into a loan by putting a complying loan agreement in place. And effectively what you've done legally is pay the money across to the company, and the company's lent the money straight back to the trust. So the fact that the full federal court now says a UPE is not a Division 7A loan for Division 7A purposes really doesn't help you anymore. Why? Because you've converted the UPE to a loan. Now, for year ending 30 June 23, although it is relevant as you've identified, because we got a UPE year ending 30 June 23. As you all know, TD 202211 says that, hey, the company's not taken to provide a financial accommodation to the trust until the company can quantify its entitlement, which will inevitably be in the subsequent year, in the 24 year. So the company's taken to make the loan to the trust in the 24 year. Okay. Because it's a deemed Division 7A loan in the 24 year, you've got until the lodgement date of the 24 return in the 15th May of 2025, put it under a complying loan. And that's where your questions come in. What's the decision that we got? Do we put it under a complying loan agreement, or do we say, hey, full federal court says we don't need to because, hey, it's not a Division 7A loan? Now, this is the key point. My view basically is that, hey, it's business as usual. Put it under a complying loan agreement for the reasons I mentioned previously. But other taxpayers may say, hey, hang on a sec. Full federal court says otherwise. I'm not going to bother putting it under a complying Division 7A loan. I'm going to run the gauntlet. Keep in mind, however, the ATO have indicated in the interim decision impact statement, they might say in that circumstance, you made the company entitled to $2.5 million 30 June 23. You didn't give the money to the company in 24. You still haven't given the money to the company after the 30 June 24. 30 June 25, the money's still sitting in the trust. That's a reimbursement agreement. Why? Because the company's been entitled, the company's paid the tax, but the trust has received the benefit. That's a reimbursement agreement. 100A applies.
Unless you got a very solid argument to hang a hat on why that's not a reimbursement agreement, like somehow it's ordinary family commercial dealing, which is probably a argument.
In their PCG and ruling basically says where it's a trust and a corporate beneficiary, it's not considered to be an ordinary family commercial dealing, even though all of those entities are part of the family group.
Yeah. All right. Oh, we got 3 minutes left, Ming.
Yes.
That was a great summary of Bendel and its practical implications. Thank you.
Very, very quickly, I'm sure that all the practitioners I'm talking to are aware of this. At 30 June, we need to make sure that, we're dotting all the I's and crossing all the T's when it comes to distributing amounts from a trust to beneficiaries. Now, a couple of things you need to be aware of. Whenever you're dealing with trusts and beneficiaries, I know it's a motherhood statement, but you need to review the deed. You need to know how income is defined in the deed, who the beneficiaries are. Whether or not the trust deed allows you to stream income and particular types of income to particular beneficiaries, particularly where you want to stream frank dividends or capital gains for tax purposes. You got to review your family interposed entity elections. Why? If you've made a family trust election, okay, one of the consequences of making a family trust election is you can only distribute to members of your family group. If the trustee distributes to a member outside of the family group, the trustee is liable to family trust distribution tax on a distribution to a member outside of the family group. So we need to be aware of that. We also need to be aware what the procedures are for making a trustee resolution. Keep in mind, Section 97 of the Income Tax Assessment Act 1936 says that beneficiaries are taxed on a present entitlement basis. In order for a beneficiary to be liable to tax on the taxable income of a trust, they have to be presently entitled to the trust income. If you don't make a proper resolution, the beneficiary is not presently entitled. If they're not presently entitled, they don't bear the tax liability. Either the trustee pays tax under Section 99A because no beneficiary is entitled, or the default beneficiaries are assessed. So we need to make sure that we follow the procedures on making resolutions. Is it a written or oral resolution? Do we minute it? And remember, you got to make the beneficiaries presently entitled in accordance with the terms of the deed. So most deeds will say present entitlements 30 June. So we need to make sure that there's evidence that we've executed a resolution by 30 June. Okay? Whether it be a written resolution, minute, whatever. If it's a closely held trust, remember we need to get the TFNs of the beneficiaries. Okay? 100A always reads as ugly head. So for those of us with family trust distributing to our kids over the age of 18, remember, if you're distributing to kids over the age of 18, the money needs to flow with the entitlement. Okay? Or it needs to be applied for their benefit. So one of the things that clients in terms of record keeping need to be aware of now is this. I've paid a trust distribution to my son who's over the age of 18. Okay? Now, I don't necessarily have to give him the money. I can offset his entitlement against amounts that he owes me. Okay? But I need to keep the records of that. Okay, so it's still for his benefit because the entitlements can offset against amounts but in order to comply with 100 days. So I might have paid for his petrol. I might have paid for his university fees. I might have paid for a number of things. Okay, I need to keep a record of that to say, well, this is what I paid for on his behalf. I'm now applying his entitlement against that. Okay, so that I can show that he's benefiting from the distribution rather than there being a situation where I make him entitled, but I keep the money. So there's a reimbursement agreement. Okay. So that's something that we need to be aware of as well. Last but not least, of course, we mentioned previously the ATO's guidelines on Section 99B. Very important. The ATO has basically given us some fairly detailed guidelines in the form of a ruling and a practical compliance guideline in terms of dealing with 99B. 99B is the provision that basically says, hey, if you are a resident beneficiary of a foreign trust, if you receive a distribution from the foreign trust, it's taken to be your assessable income unless you can prove it comes from the purpose of the trust. And one of the number one things is the guidelines highlight the situations where 99B could apply, most relevantly where you receive a distribution from a deceased estate. It also highlights the documentation and evidence you have to show in order to demonstrate an amount comes from corpus. So it's very important that taxpayers are aware of that as well. And I'm sorry we've had to go so quickly because we've got so much material to cover, but that's pretty much it for year-end tax issues.
Amazing. That was epic, Ming. And for those that are new to us, if you found this session useful, you're welcome to come and start a free trial with us. We've got a 10-day free trial. So head to taxnuggetsacademy.com.au to check us out. And we also have team subscriptions if you're interested in us for your staff. Moving along to Q&A, I think we might just take a couple of questions if you are still available with Ming for just saying.
Most certainly.
Yeah, and I'll just try and answer some of the more common questions and consolidate them. There were a few questions around GIC and SIC.
Yep.
So can you just remind us about the rules again? So only GIC and SIC accrued post 1 July. It's not about when the debt was incurred.
It doesn't matter when the debt arose. So if you've got an unpaid tax debt, it could have arisen prior to the 1st of July 25. If interest that accrues on that debt after 1 July 25, it's non-deductible.
Yeah. And then what happens if the GIC SIC is remitted?
Very, very good question. So if the GIC or SIC is remitted, right, okay, ordinarily, well, because you previously claimed a deduction, it's assessable recoupment, you've got to actually include assessable income. Now, if it's non-deductible, then you would not really be required to include your assessable income.
Good. That makes sense. Just a quick couple of things to clarify, and I think this is a big one for year-end. If a Div 7A loan repayment is paid by dividend offset,
yep.
Does the dividend, need to be physically paid, or can it just be like paper offset against
can be by journal entry. When you do it, doesn't matter. What you need to make sure is that you've got the documentation to show that the dividend was declared prior to 30 June, and there was an agreement to offset the dividend against the shareholders' loan obligations. Okay, very, very important. Okay, so when you do the journal entries, doesn't help, and it doesn't matter. It'd be nice to do the journal entry before 30 June, but we're all accountants. We know that's not going to happen. Okay, but we need to have documentation in place to show the dividend was declared and there was an agreement for the offset to occur prior to 30 June. Provided that's the case, that's sufficient. So that doesn't have to actually be cash changing hands necessarily.
Mm-hmm. So it's more the documentation is so important to get done before 30 June.
Correct.
And it's not sufficient to have just journal entries?
No.
Okay.
So just numbers on a page. Okay. I know accountants think that, they're gospel, but journal entries are just numbers on a page. We need the documentation to basically say the form is and the substance correspond.
Yep. All right. I think that's all the time we have left for today. Apologies if we didn't get to your question, but there were just too many questions today. And Ming, one final key takeaway to summarize, what 2025 year end we should look out for.
I think with year ending 30 June 2025, a lot of the announcements that were made by the government actually, they're all going to be, subject to the outcome of the election. So in terms of our planning, we're just going to need to wait and see what happens. For example, one of the biggest ticket items that's going to be a concern for our clients will be the superannuation changes. Okay. And what I'm referring to, and which I didn't mention today because it's still not more yet, is of course the proposal by the government to tax earnings.
Unrealized gains
in excess of $3 million, we'll levy additional tax. Okay. And the way it works is, as you all know, unrealized gains will be subject to tax. Now, those rules were proposed to apply from the 1st of July 2025. So a lot of clients have come to me saying, look, should I be doing something about valuing my assets ending 30 June 25? What should I be doing to make sure that, this new tax doesn't apply to me? And my response has been, well, unfortunately, the legislation hasn't been passed by Parliament. Whether or not we've got to deal with it will very much depend on what happens on Saturday. Because the coalition have indicated if they're elected, the super measures are gone. The government have indicated if we're elected, it's a mandate to go ahead with those changes.
Yep.
As to whether or not it's going to be applicable from 1 July 25 or a later start date, we still don't know. Like I said, a lot of our planning, unfortunately, for year ending June 25 will be dependent on what happens, in the event that we can't file a crystal ball at the moment.
Anyway, tax and politics, you can't divorce them. And so the only certainty is, uncertainty in our business. So thank you very much, Ming. And thank you everyone for joining us. You've been super awesome in the chat and super engaged. So thanks very much. And please put your emoji hands together one last time to say thanks to Ming. Hey, we'll catch you next time.